All right. Good morning, everybody. Welcome to today's open forum. Today, we are going to be discussing real estate investment basics. These are basic real estate investment ideas and how it all works so you know what you're talking about when a potential client comes to you and talks about investing. So what we're going to do today is go over these basics. If you guys have any questions, feel free to pipe in. I won't always be able to see your hands raised. So if you would like to, you can just butt in anytime, but let me know as we go along. So let's get started. All right, what we'll cover today: help your buyers evaluate investment property more confidently, learn the language investors use, ROI, ROR, cash on cash return, NOI, cap rate, cash flow. Don't worry about those right now. We're going to get to all of them. Know where your role begins, where it ends, and who else should be involved. All right, so we talk about this, and we do this once a year or so. We talk about investors and how to present yourselves to them and how to find out if one of the biggest things we do is waste time for investors. And what we want to do is find out if they're legitimate, if they know what they're doing, how much guidance they need, who we should work with, what our team should look like, who they already have on their team. And we're going to get to some of that stuff as we go along. Okay, what you should be able to do after this. So my goal here today is for you to be able to explain basic return metrics in plain English or whatever language you speak. Ask better questions when a buyer says, I want an investment property. Screen a rental, short-term rental, or flip without overpromising. Spot assumptions that need verification before the offer, inspection, or closing. And create long-term value so investor clients buy again and again and refer others. So what is your role with investor clients? Things you help with and things you do not. Property searches, sales comps, rent comps, resale demand, offer strategies and contract timelines, coordinating inspections, lenders insurance like you always do, HOA condo review, and property manager input. Things you do not do. You do not replace the CPA or tax advisor. You don't replace an attorney. You don't replace a financial advisor. You don't replace lender or insurance expert. And you don't replace the contractor or property manager. Do not overpromise these people on what their returns are going to be or anything else. All you can do is show them what you've seen and what you can find. Be careful about all of that. Don't tell them what kind of tenants they're going to get or anything like that. You know, this area always gets great tenants. Just be careful about that stuff. Why agents need investment basics. Investors make decisions differently than emotional owner occupants, as you guys know. Numbers, assumptions, timing, financing, and exit strategy all matter. A deal that looks cheap can still be a bad investment. We see that a lot. A deal with thin cash flow may still make sense for the right client and strategy. Agents who understand the conversation become more valuable and more referable. So I want to talk about the something that looks cheap can still be a bad investment, and the ones with thin cash flow may still make sense for the right client and strategy. That is why we ask all the questions that we ask up front, because my investment needs are different than Pauline's, than Daryl's, than Tammy's, than anybody else's, right? We all have different goals, needs, abilities, price ranges, everything else. So those are the things that you want to never assume based on, investor, the last investor client you had. Not all investors they're like snowflakes. They are all different. They all have different goals and dreams and desires and strategies. And some don't have any of that at all, and they need a strategy. So that's where all these questions come in. If you guys ever need help with that stuff, you can ask me. First question is, what is the strategy? A long-term rental, stable tenant income, and long-term wealth building. A short-term rental, higher potential income with higher regulation and management risk. Fix and flip, buy, renovate, resell for profit. House hack, owner occupies part of the property and rents the rest. Those are becoming popular now, and I'll get into that a little bit on this slide. Future primary residence, rent it now, move in later. We don't see a ton of that because that makes financing more difficult, but it happens. Okay. Long-term rental, that's what we do at FRI. We manage a bunch of long-term rentals. That's what people typically want to do when they buy an investment property. I know Daryl, for example, has a lot of long-term rentals. That's what he does. Short-term rentals. You guys know a lot of these. You guys sell a lot of these Airbnb type properties. We call them short-term rentals. Potential income with higher regulation and management risk. And I want to get into the higher regulation. One of the reasons I would not do this personally, and everybody's different, right? A lot of people do it. A lot of people do great with it. I would not do it personally because I don't trust the government to not overregulate this and even get rid of it where they can. So, and you have something like COVID and you just go absolutely penniless for a while. So that's something that bothers me about short-term rental, but that's me, right? And other people do great with it. Fix and flip, you guys know that's settled down a little bit because it's been hard to sell stuff. House hack, this is what I want to talk about. This is the additional dwelling units have become very popular and allowed in a lot of places now that they weren't before. They're doing it under the guise of affordable housing, so they're letting us build additional dwelling units on a 2,000 square foot property. You can put another 800 square feet additional dwelling unit. They're approving those and even encouraging them in a lot of jurisdictions now. And that's a new thing from pretty much in the last year or so. So that's something to look into. I know, is it Marion County, Ocala, some other places are really getting into that. So sorry, I had to cough. Let's go to the next. What residential investors usually want. They want cash flow. They want money left after income, expenses, and debt service. They want appreciation, obviously. They're buying in areas that are going to increase in value over time. Equity buildup. Tenants help pay down the loan balance. Obviously, that goes along with, they're hoping when they get rid of this, the tenants were paying their rent and all their expenses the whole time. That's the whole idea of it. Tax benefits, depreciation, deductions, and possible 1031 exchange planning. If you don't know 1031s, that's a whole different thing, but we'll touch on it briefly today. Portfolio growth. One successful property can lead to the next purchase. And I want to get back to 1031s. 1031s have what's called intermediaries, and they need one for every deal that they do this. And please don't Google and explain the rules to them. Have them talk to the 1031 exchange person. They can give them much better advice than we can by Googling and telling them what we read, or even have them Google it themselves. Because things change, and as you guys know, Google and AI are not 100% caught up with everything all the time, and they'll pull the wrong thing, and different states have different things, and it's just too much for you to get involved in. We don't give financial advice, and 1031 exchange planning is definitely financial advice. So you always want to have an intermediary. If you don't have one, I know one. I don't know him well. I just know a guy that's done a bunch for a client of mine. Equity buildup. This is what we talk about. Tenants help pay down the loan balance. That's why when we talk about insurance and property taxes and all that, it's not just for owners. The tenants pay them, right? When your insurance goes up and your property taxes go up, you try to pass that on, and the rent goes up as long as the market supports it. So we'll talk about all that stuff. And your clients always want to buy. That's why Florida is such a hot area for this. The appreciation, increase in property value over time. So you get the cash flow. You get the cash on cash return, typically is what people want. People will come up to you and say, Carolina, I have $100,000. I want to make it work for me in real estate. And she'll try to find them something that maybe they have $500,000. It doesn't matter what it is. She'll try to help them find something they want the most money they can make off of their $100,000. Sometimes that's leveraging. Sometimes that's just buying something maybe they can't leverage or they don't want to. So they just want to buy something that's $100,000, whatever that is. But most of the time, they'll buy something that's $300,000 with that $100,000 and have that return. So by leveraging, borrowing money. Move on. Oops, too far. Okay. Sorry about this design. This is hard to look at. This is investor vocabulary agents should know. Very important. Gross rent, total rent before expenses. Operating expenses, recurring costs before the mortgage. So NOI is income minus operating expenses. Operating expenses are everything outside of the debt service, which is the mortgage. Okay. Debt service is the loan payments. There we go. Cash flow. money left after expenses and debt service. That is what they want to know. If my mortgage and expenses are $1,000 every month and I'm renting it for $1,200, then $200 is my cash flow. Okay. Equity, that's the value minus the loan balance. You guys know that's the same as every house ever, right? Whatever your value is minus what you owe on it is your equity in it. It's built by appreciation and principal build down, just like a house, just like every house you've ever sold, right? So those are pretty basic ones, and we'll get into a few more as we go. But let's talk about these individually. Return on investment. The formula is ROI equals net profit plus total investment. Remember, net profit divided by total investment. That's your ROI, your net profit. So if you're making $10,000 a year on something and you paid $100,000 for it, your ROI is 10%, right? And I'm going to keep the math really easy, even if it doesn't make sense for today's prices. ROI measures total profit compared with total money invested. ROI can include cash flow, appreciation, principal buy down, and sale profit. I'm going to tell you guys right now, we always talk about ROI. People talk about ROI on everything, right? They don't. ROI is an overused term. And we're going to get into some of the other ones that make a little more sense. Like this question. I like this. First of all, here's why. You have to clarify the time frame: 1 year, 5 years, or full ownership period. Your total ROI cannot be obtained. You can't get that number until you actually dispose of the asset for the whole ownership period, right? But if you're talking about a 1 year ROI, what's your return on investment? This gets confused with cash on cash return. It gets confused with several things. So I like to use different things. I like to use ROI for the entire ownership period. That's me. I don't believe in like a 1 year or 5 years. That's a more of a rate of return than it is an ROI. So I don't want to get bogged down in that. But rate of return is the ongoing rate, and similar to a cap rate, it's the ongoing thing. But ROI is what is it? Because you have to include all these things. You have to include cash flow, appreciation, principal pay down, and sale profit. You have to do all of that to know. And at the end of this thing, you can say, I spent $500,000 on this property over the 5 years that I owned it, and I got this much back, and that was my rate of return. When I put all this money in, I got this much back. That and all the rent along the way, minus all the expenses along the way, and that's how much I actually made. That was my rate. That was my return on my investment. Okay, and everybody wants a high return on investment, obviously. Simple ROI example. Oh, this got too big. Sorry. Someone puts $100,000 into a property, puts for rent, resale, costs, and payoff. Total gain is $40,000. 100,000, it was whatever the rate of return is. 40,000 divided by 100,000, it's 40%. Timing matters. 40% 1 year is very different from 40% in 5 years, because it does have to be annualized, right? And you have to go back. If I made $40,000 on this $100,000 in 6 months, that'd be great. That'd be an 80% annualized return, right? But if it took me 10 years, that's a 4%. Really less if you go into compounding, but I'm not going to get into that. So agent takeaway: ROI without a timeline could be misleading. That was my whole point of the last one. The ROI without a timeline could be misleading. What people really want is a rate of return. And here you go. This is your annual rate of return equals your annual profit divided by your investment. That's what they want. They want to know, how much can my 100,000 or my 500,000 bring me every year, right? That's what they went to when they asked you about their return. Unless it's going to be a long-term investment, but mostly they want to know the annual profit divided by the investment. And this, we'll get into this. So ROI usually expresses a return for a specific period, often 1 year. It helps compare investments with different hold periods. Annualized return converts a multi-year result into an average yearly rate. The agent script: is that projected return annual, total, or annualized? So rate of return is what people typically want to talk about. That's what they want to know, what they can make with their money, and they're looking for the best rate of return. Same with any other investment that they're doing. The cash on cash return. So this is even more broken down to exactly what they want to know. Carolina, my $100,000, how much cash on cash return am I going to make? And I will tell you right now, we normally do, when I do this, I do a different one with examples. And one of those things that we looked at was financing, what their return would be if they financed versus what their cash on cash return would be if they finance, and their cash on cash return would be if they just paid cash for something. The financed return is obviously higher. I believe in our example, it was about 11%. The example I gave, 11% for cash on cash, and it was 24% for finance. But so financing, which we're going to get to in here in a second, I've got a slide on that. Financing is going to increase your cash on cash return, but it also increases your risk and everything else. Okay. So cash on cash return is your annual pre-tax cash flow divided by your cash invested. It's very useful for financed rental property. Cash invested usually includes down payment, closing costs, repairs, and initial reserves. It focuses on actual cash flow, not appreciation or tax benefits. Agent takeaway: a property can appreciate and still have weak cash on cash return. It can, but that's not, appreciation is the least guaranteed of all of these things. So you have to be very careful buying. That's just speculating, buying on appreciation. Okay. That is just speculating. And you're not, that would be like doing a flip, but you don't do any work to it and you just hope to sell it for more later. Right. So you need to be focused on what their cash on cash return is, not just banking on appreciation. All right. Cash on cash example. I could not find a picture of cash. So I've got coins. Monthly cash flow after expenses and mortgage, $400. And so that's cash flow. So that's if my expenses are $1,000 a month and I rent it for $1,400, right? That's my annual pre-tax cash flow would be $4,800. My total cash invested in this example is $80,000. Cash on cash return is $4,800 divided by $80,000, which is 6%. And the agent script would be, does this cash flow meet your target after reserves? So 6% doesn't sound like a lot, but 6% cash on cash return is pretty good because you've also got appreciation. You've also got all of these other things adding to this. So this is a pretty good, decent, reasonable thing. The other example I gave was 11%, I believe, and that's a great cash on cash return. So that's what people really want to know. If this is in a good area and it's appreciating and everything else, then they might be fine with that. And if they're just making $4,800 on their $80,000, maybe they're fine with that. Depends on the investor, right? So none of these are good or bad. They just are what they are. And different things work. And you know what? A lot of investors will say 6%, no thanks, right? And other ones will be like, that's fair. All right. Cap rate. Cap rate equals the NOI divided by the purchase price. So this is taking into effect everything. Okay. Cap rate measures return before financing. It helps compare properties with buyer-specific loan without the buyer-specific loan terms. More common in income property analysis, but still useful for residential investors. Agent takeaway: cap rate should not replace a full cash flow analysis. Obviously, you can't just do that. So a cap rate is what I normally talk about when I do the commercial section of our investment. Cap rate is used in the commercial real estate world. If you want to buy a Walgreens, typically a Walgreens is one of the ones that's always owned by someone else and they just rent the building for 30 years. And Walgreens cap rates are usually low because they're a AAA credit tenant and, you know, blah, blah, blah. So cap rate itself doesn't mean much without knowing the tenant and the length of the term and everything else. So the whole thing has to be taken into account. Again, we're talking about, you know, a Walgreens property you might pay $2 million for, and it pays you X amount per month. And usually the cap rate's like 7% or 6%, or actually, no, for those, so you get like a cap rate of 5 on those because you've got such a good tenant in for such a long time. All right. Carolina, oh, real estate. Thank you, Carolina. I'm glad that you're enjoying this so much. And I know you're being sarcastic, so thank you. NOI. I feel like we already did this, but maybe not. NOI is gross income minus operating expenses. We didn't do this. Includes rent and other income such as pet rent or laundry income. Operating expense may include taxes, insurance, repairs, HOA, utilities, vacancy, management, and reserves. NOI does not include mortgage payments, does not include debt service, what we call the debt service. Agent takeaway: NOI is the bridge between rent and real performance. Cash flow. Cash flow is NOI minus debt service. So that's your NOI is what your total was after expenses. Now you take out, if you borrow money, obviously your NOI is your cash flow if you didn't borrow money, if it's just cash. NOI is Cash flow is your NOI minus your debt service. Positive cash flow means income exceeds expenses and loan payments. Negative cash flow means the owner must contribute money to hold the property. Some investors accept lower cash flow for appreciation, location, or tax strategy. Are you comfortable with carrying this if rent, insurance, or vacancy changes? Can you afford to take a negative cash flow for a little bit? And a lot of people, like it says here, some investors accept lower cash flow or even negative cash flow for appreciation, location, or tax strategy. They might buy it because they really think it's going to go up. They might buy it because their accountant told them to spend some money. There's lots of reasons they might buy something that doesn't look good cash flow wise. So this is why it is so important to talk to your client before you spend a bunch of time doing all this stuff. And if they say cash flow, what do you mean? They're not ready. They're not ready yet. We have, we're going to go over a few questions in here. We have an entire questionnaire on your paperless pipeline under the reference tab. There's something called the investor questionnaire. I've written you a bunch of questions that you should get answered by your clients before you make them your clients, before you spend a lot of time on them. Okay. Quick screening metrics. This is what the reason I have this this little binocular thing here is because we're just looking at something quickly from a distance just to kind of screen these things. When you talk to your clients, they're going to give you some guidelines. When they answer these questions, you're going to have some guidelines. You got to have somewhere to work from before they say, just send me every income property in Orlando or Tampa or wherever you're at. Just make sure that you get these their criteria first, just like you would if they were buying a home somewhere. You wouldn't put them on an auto search until you knew the size and the location and the price and everything else, right? So you're going to do the same for this. This is going to be how you're going to look. The price divided by the GRM is the price divided by the annual rent. The rent to value, the monthly rent divided by the purchase price, right? Those are quick filters, not final decisions. So you got to look at all the other things involved. They do not account for taxes, insurance, HOA, repairs, vacancy management, or financing. But this is where you can start your search, right? This is where you say, and it says it on the income property. If you look on MLS or if you look in LoopNet, if it's a commercial one or whatever you're looking for, it's going to give you LoopNet's going to give you cap rate, but the MLS under income properties, it obviously gives you the asking price, and then it gives you what the income is on it, what it's renting for now. And you might find something like Daryl buys these. Daryl will look for something maybe that it might not make sense right now, but he knows it's under rented. He knows the market value for the rental is more than what they're actually getting now. And so he can actually make money with this investment, even if the numbers don't look great when you look at it right now. And there's other ways, or it's in a great area. It's in an area that's going to be gentrified or something like that. It's a block away or whatever it is. And so he wants to do that. Agent takeaway: use quick screens to decide what deserves deeper analysis, so you do not waste time. Okay, leverage. Why financing changes everything. Leverage means using borrowed money to control a larger asset, using other people's money, guys, to control a larger asset. Good leverage can increase returns when the property performs well, obviously. Bad leverage can magnify losses when rents, expenses, values, or loan terms move against the investor. How do you know good leverage from bad leverage? You don't. It's all about the market. So when the property performs well and what you're adding in value and how you're managing it and everything else, there is no good leverage or bad leverage. You're borrowing the money. You don't know if it's good leverage or bad leverage at the time, but it can magnify losses when rents, expenses, values, or loan terms move against the investor. But it definitely increases your cash on cash return. All of your numbers are better when you are able to finance, able to leverage, and the property performs. Interest rate, down payment, loan terms, points, and insurance costs can make or break the deal. The agent takeaway: update the analysis when the lender updates the numbers. You can take that away from it when you get all of your interest rates and everything else. You know what it's going to actually cost you. But when you're determining whether you should finance or not, you need to understand how leveraging works and what that's going to do to the final numbers. So that's why it's important to understand this NOI, the operating expenses, and all that stuff, and the debt service, and how that all works together. Okay. Rental analysis, basic line items, gross rent, expected monthly rent times 12. Why that matters is starting point for the deal. Obviously, those are things you're checking up on before you. That's the ones with the binoculars. You're just making sure that it's something that you even want to look further into. Estimated, vacancy allowances, estimated lost rent between tenants. A bigger project would do a 93 or 95% rental occupancy. Let's say you had a 40 unit thing. Most people would throw in like 93, 95% occupancy, and that 5 to 7% would count. A vacancy would count against your numbers. It protects against perfect world assumptions, right? We've all done that. We've all said, "Oh, this is going to make you this much every year." You're gonna, if it rents for $2,000 a month, that's 24 grand every year. Well, we know that doesn't really work, right? There are other things. There's vacancy from time to time. You got non-paying tenants, slow-paying tenants. You have all that stuff. Operating expenses, taxes, insurance, HOA, repairs, management, utilities, and reserves. That determines your NOI, your net operating income. I want to go back to the last one some. You guys will get clients who are sophisticated and know what they're doing, and they want you to send them properties, and they set their sites really high. And they'll say, when I say that, they say, I only want something that's going to make me 12 to 15% a year. And maybe the reason they do that is because they're working in all these other numbers. They're working against these perfect world assumptions. Okay. They've owned enough properties that they know they've got lost rent between tenants. They've got, and when a tenant moves out, you got to do a turn. You got to paint the walls. You got to do this, got to do that. It's expensive, and makes your property sit for a month and a half, 2 months, right? So they've got to take all of that into consideration. And that's why a lot of them give, lower rent to tenants who've been there 10 years because they've never had to do a turn. They don't have to do much. Maybe they're great tenants and they pay on time, and you all know people like that. People who say, I want to sell this property. The tenant's been there so long. They're so great. I hate to see them go, whatever it is. Or you'll buy a property, you look at buying something, and the listing agent will say, yeah, I mean, the rent's low, but they've had this guy there for 10 years, or this lady's been there for 20 years or whatever. So they keep her rent low because she's such a great tenant. You will run into some of that stuff. And that's all, that's all protecting against perfect world assumptions. All right. Debt service, loan principal and interest. That's obvious. Turns NOI into cash flow. If you didn't borrow money, your NOI is your cash flow. If you borrowed money, you got to take the debt service out. That is what you pay. That's what you pay on your house every month. If you own a house, that's your mortgage. Same thing. Initial cash invested, the down payment, closing costs, repairs, and reserves used for cash on cash return. That is the thing a lot of people want to know. I've got money. I want to invest it. If they're not sophisticated investors, they'll tell you, they'll come up to you at a dinner party or wherever you are, and they'll say, yeah, man, I've been looking to, you're a realtor. I've been looking for investments, but I don't know where to get started. I've got, I don't have much, got a couple 100,000, got however they present that to you. And now you'll know how to help them, right? What would you like to do with that? Are you looking for a long-term hold? It's all on the investor questionnaire. And what will your exit strategy be? And maybe they'll say, I just want return on my money for as long as I live, right? Maybe they don't know, and they don't have to know. They can just, that would be like a long-term hold, assuming they live a long term. All right. Example rental deal. Gross rent, $2,400 a month. That's $28,800 a year. Vacancy allowance, $120. My quick math tells me that's 5%. The annual of that, $1,440. The operating expenses is $760, so that comes off $760 a month. Operating expenses, that's $91.20 a year. Your NOI $1,520 a month, $18,240 for the year. That's your net operating income after you receive the rent minus the expenses and vacancy allowance, right? So the debt service is $13,800 a year. This person is making $4,440 a year, cash flowing $370 a month. If you invested $80,000, that's a 5.5% return. They're probably also counting on appreciation in this unit, right? They're making $4,400 on their $80,000, but what they'd like to do is get some appreciation in this as well. Okay, and this is just an example rental deal. I'm not crazy on that cash of that. I would not consider this a good deal unless they have other, for me, it's not a good deal. For someone else, it might be great. That's why you have to ask the questions. Depends on what they're trying to do. Appreciation, equity, and total return. Cash flow is only one part of the investment story. Total return may include cash flow, appreciation, principal pay down, and tax benefits. If I own that property, let's say I put that 80,000 in and I own that property. Let's say with that 80,000, I had to put 20% down. So I paid 240, I paid 320 for that property. I had 25% down, let's say. So I paid 320 for that property. Okay. And I own it for 20 years. When I go to sell that, so I borrowed 240. When I go to sell that, I'm only going to owe, after 20 years, I'm only going to owe $60,000. Okay. So now I owe $60,000. Hopefully it's worth, after 20 years, I paid 320. Hopefully it's worth 550 now, right? Who knows? But let's say it's worth 550 and I only owe 60. I'm going to make $490,000. Well, minus the 80 I put into it. And plus all the money I made along the way, the little $4,000 a year that I made along the way. And then I'm going to have equity built in because I've been paying down my mortgage and it's appreciated, right? Now that 4440 a year doesn't sound so bad now that I made 310 on the back, right? You guys know that 410, 550 minus the 60 I still owe minus the 80. So I made 410 on the back end of that. Tammy, you have a question?
Yeah. Do you have to pay back all of your depreciation that you took over the years on an investment property?
That's an accountant question, and it varies. It really is an accountant question. I'm under the impression that you don't. It would be part of your tax strategy. I mean, it's not. I can't answer that question. It depends on the property and the investor and what else you have going on. I don't know. But if you're taking depreciation on your taxes, I'm sure that you don't just get it, that would be added back on or something when you pay your final tax, when you dispose of the asset. Okay, long-term rental, what agents should check? Rent comps from active, pending, and lease rental properties when possible. Obviously, if you've got neighbors and everything else, if it's a condo or something like that, you're going to have plenty of that. Neighborhood tenant demand, school zones, commute patterns, and resale liquidity. Those are all things you can find on, school zones, obviously, you can find. But the tenant demand and the resale liquidity you can find on your MLS, what's been selling. Rent comps, you can find on your MLS. How long are they sitting on the market before they do it? That's how you find the tenant demand. How long are these rentals sitting on the market and at what prices? Are we going to come in below them, above them? That is as important as any other thing when you try to figure out what you can rent or sell for. Just like when you guys do comps for your clients, you can't just run a CMA. You also need to look your CMA says your properties, it's because you'll have a client, and you guys have all had this, you have a client that said CMA says it's worth 400,000, but there's 4 properties in their neighborhood sitting at 390 on MLS and they're not selling. So is their property worth 400,000? Not right now, right? So it's the same thing for these. So when I tell you, when things are renting for X amount, if you say, wow, this rent should be $2,500 a month, but the one that was $2,300 a month sat on the market for 114 days, that's not good, right? We can't just throw it up for $2,500. Or if there's more out there that aren't renting at $2,300, then it's not worth that. You have to be very realistic about this stuff. Insurance, taxes, HOA, utility setup, and property management fit. Major systems, roof, HVAC, plumbing, electrical, water heater, and appliances. What are those like? What kind of expenses am I going to have when I buy this thing? Local rental rules and any community restrictions. These are all things that you can check for. This is where your value comes in for your client. Okay, these are all things you can do really easily. Most of them by asking the list at the bottom here, by asking a listing agent. Current leases, deposits, rent roll, and 2 to 4 unit residential. What agents should check? Current leases, deposits, rent roll, and tenant payment history. You guys know what rent rolls are. That's just the list of who's paying rent and how much. Obviously, you see that with the current leases. If we're talking about 2 to 4 units, it's not a big rent roll. You can just look at the leases and tenant payment history. Some of that is protected information and some of it is not. Depends on the seller, really. Utility metering, separate, shared, landlord paid, or tenant paid. Obviously, it's important to note that's landlord paid. Condition of each unit, common areas, parking, laundry, and exterior maintenance. Let me go back to the utility metering. Separate, shared, landlord paid, or tenant paid. If it's landlord paid, it'll be on their list of expenses. But ask these questions, find out how they're all done. You need to know if they're separate, shared, or tenant paid, separate or shared anyway when you're leasing the properties. Condition of each unit, common areas, parking, laundry, and exterior maintenance. Financing assumptions, because 2 to 4 units may still be residential, but underwriting can vary. I like to think under 4 units. Everything I always hear is 4 units or less is residential, but it may be different. Whether current rents are market rents or below market rents. That's what we talked about a little bit earlier. You might see something. You might see something and be, wow, I can't believe the rents there are that low. That's why you really need to know that area. A lot of listing agents or sellers will tell you, oh yeah, but I just haven't raised the rent in a long time. These are below market rents. I'd be wary of that. Why would they not get the rents up before they sold it? That's what I would do if I could. So be wary of that as well. Unless you absolutely know better, be wary of that. Okay, condos and townhomes, what agents should check. HOA fees and how they affect monthly cash flow. Also what they do, what those fees cover and don't cover. Rental restrictions, minimum lease terms, approval process and waiting lists, special assessments, reserves, insurance, litigation, and budget health. These are all, especially nowadays with condos and stuff. This is why we've had a condo crisis in Florida. With the one that collapsed down in Miami, there has been all kinds of overreactive laws written. I'll say overreactive because they're on 3-story condos compared to the giant one that crashed. They're on everything, and they're over reserving everyone. They're making these HOAs get tons of reserves. They've started to lessen that now. They've gone again reacting back the other way now and giving these HOAs a little bit of a break because special assessments have gone through the roof, and nobody trusts the condo HOA or COA. Nobody trusts those things because they just kept doing assessments and assessments and assessments, and it's all because required reserves have gone through the roof because of and the testing they have to have done and all that stuff. So just be careful with all that stuff. Whether short-term rentals are prohibited by condo docs or community rules. I have seen this, guys. I have been at FRI 11 years. I have seen this probably 5 times where you guys have either been on the buying or selling end of something that people cannot rent. They were told they could rent and they couldn't, and short-term as well. So, or restrictions changed over time, and now the new buyer isn't grandfathered in. You just have to be careful with these things. Agent takeaway: a great-looking unit can be a bad investment if the rules do not fit the strategy. I've had you guys sell houses to a guy who's a plumber, and he thought he could park his plumbing thing. It didn't. Nothing was in the presented documents about. Nobody told him he couldn't park his plumbing truck in the driveway. Well, guess what? That was not disclosed, and there's lawsuits abound when they do that. He'd already closed on the house. So bad job by both agents, and I don't know how they dropped the ball on that. No one reviewed the HOA rules. They saw the fees and everything else. It was disclosed there was an HOA, but as a buyer's agent, you have to get into the documents, and condos even more so. Okay, and there's also there's also a limit typically on how much they can raise your HOA, so you have to be careful about that too. Find out what that limit is. With 3%, 5%, whatever they can raise it annually. Okay, short-term rental basics. Potentially higher gross income, but more variable and management intensive. Success depends on location, regulations, HOA rules, seasonality, furnishing costs, and platform performance. Expenses are usually higher, obviously cleaning expenses, utilities, supplies, maintenance, management, vacancy, and replacement items. Because when I rent someone a house, I don't have to make sure they have toilet paper. They're in charge of that, right? I don't have to make sure they have all these things. Do not rely only on best case revenue projections. That goes for all of these, every investment ever. Do not rely on best case revenue projections. There is no perfect world. Agent takeaway: verify rules, licensing, tax, insurance, community restrictions before offer deadlines. Where we want to go back up to. Success depends on location, regulations, HOA rules, all that stuff. Also on marketing and filling the unit And that's a huge thing. And some companies charge 20%, some charge 40%. Just be careful with what you get charged. Make sure you get the best deal out there, or make sure your client does in that case. You don't want to get too involved in picking your anything for these people, but you do want to get them all the information. Okay, fix and flip basics. Profit comes from buying right. I always say that you make the money when you buy, not when you sell. Profit comes from buying right, controlling rehab costs and reselling at a realistic ARV. Guys, you cannot control the ARV. You can control what you buy it at. Can't really control what you sell it at, right? Just if it doesn't fit, buy another property. ARV means after repair value. You guys remember that. You'll see that a lot. Supported by comparable sales. Common mistakes: overestimating ARV, or taking someone's word for it when they send you an email. Look at this property. You can buy it for 80. It needs 30, and the ARV is 320. That's not probably right. So be very careful with those. Don't just take someone's word for it. Underestimating repairs and ignoring holding costs. Yes. Is it the same if you hold it for a year? You want to flip it in 2-3 months. You don't want to hold it a year. Think about all the opportunity costs that is too, which we're not going to get into. But opportunity cost is a financial basic fundamental of opportunity cost, because one bad property, or one property that takes a long time to sell, keeps you from doing 2 others, right? And so that costs you a bunch of money. Time matters, because every extra month adds risk and carrying costs and opportunity costs. Agent value, honest comps, buyer demand insight, access coordination, and realistic resale strategy. Make sure you're doing all that for them. Honest comps, buyer demand insight, access coordination, and realistic resale strategy. How do I know that 320,000 ARV the listing agent promised in their email that they sent to 10 million people? How do I know that that's a real ARV? I look at the comps in the neighborhood, and I look at other units, buyer demand insight. If it says 320 ARV and I look on there and there's perfectly renovated houses that are at 290 and not selling, that 320 is not the real ARV. Okay. We'd have to go below that to sell the property quickly. And the whole idea of buying this is selling it quickly. Now, the example I gave of 80,000 and 30 to put in and still sells for 250, that's great. But in a more realistic one, they'll sell it for 200. They'll say that it needs 50. We all know that's probably not right. Might need more than that, right? Based on what it needs. And that the ARV is 320. And so, wow, I'm going to make $70,000, right? If I just listen to everything they say. But by the time we break that down, we realize the 50 is probably 60, and the 320 is probably 290. And now we've got a $30,000 profit in 6 months on this investment. It's not worth it. Okay, typically, right? So depending on what those numbers are, but what I'm saying is we got to prune the fat, the perfect world stuff, and get to what actually the return would be. Okay, flip screening formula. Max offer is around the ARV minus repairs, minus holding cost, minus selling cost, minus desired profit. Desired profit is what really varies based on the person. It's also based on how long they think they're gonna hold it. But holding costs, selling costs, repairs, and ARV is obviously the end income, and then all of these are the outgoing. The desired profit is just how much I think it's worth for me to do this work, use my capital, and do this work over a set amount of time, right? So the example I gave where you're only going to make $30,000 instead of $70,000, it probably wouldn't be worth it. Repairs should include a contingency buffer. Holding costs include loan payments, utilities, taxes, insurance, HOA, and project delays. Guys, those last two, including a contingency buffer and project delays, the typical saying for these things is they take twice as long. Take twice as long and cost 3 times as much as you think when you first take them on. So be careful about those. Selling costs include commissions, closing costs, concessions, and staging if applicable. Agent takeaway. If the max offer is far below list price, the deal may not work. Meaning if the most your client will pay for this property is so far off of what they're asking, then it probably won't work. Due diligence questions to ask investor buyers. This is where we get into some of these. What is your primary goal? Cash flow, appreciation, tax planning, flip profit, or portfolio growth? Guys, use the questionnaire I gave you, covers all these things. What is your maximum cash investment and reserve comfort level? Will you self-manage or hire property management? What financing terms are you approved for right now? And what do you want to borrow? Do you want to borrow? How much do you want to borrow? How comfortable are you borrowing? Somebody might be really advanced age and they're risk averse, and somebody might be young and gung ho and whatever. Let's shoot for the moon here. What return metric matters to you most? Talked about all of those. Mostly it's going to be a cash on cash. They'll say ROI because they don't really understand, but cash on cash. And then if, like that example I gave where they put the 80,000 and eventually it became worth 550 because they leveraged, that's a wonderful return. They kind of explain that possibility to them, kind of explain that strategy to them as well. Don't use those exact numbers, use whatever their numbers make sense for them, but use that exact thing. Do you think you're going to own this 20 years? Is this something you're going to leave to your kids? Is this something you're going to, whatever? Who is already on your team? You have a CPA, a lender, insurance agent, an attorney, a contractor, a property manager. Who's already on your team? They may already have 12 properties. They may already have 50 properties. They may have one property. They may have none, never heard of it before. They're just looking into it. So whatever that is, you need to know. And you need to have it on a team. You need to develop a team of people you can refer to them, because they're going to ask you, do you have a CPA and a 1031 intermediary? If you don't know one, I can give you the guy that I use that I don't really know, but he's done a good job for everybody. So I can do that as well. All right. Red flags agents should slow down for. Rent estimates based only on listing remarks or seller promises. Obviously, do the work. Find out what they really are. No reserve for vacancy, maintenance, capital repairs, or insurance increases. You cannot say, remember that $80,000 we're investing in this $320,000? Don't let that be their last $80,000. They need to have some, it's not a perfect world. They're going to have some repairs, maintenance, vacancy, insurance increases, property tax increases. They're going to have all that stuff. Make sure this is not, they're going to have times of negative cash flow. That doesn't work if this is their last $80,000. So make sure they have some reserve. If they say they have 80,000, let's say, for an example, I'll give you an example. Let's say you run into somebody and they're hardworking, they're a firefighter, a teacher, or something, and they've scratched together $80,000, and they tell you, I scratched together $80,000. Tammy, I want you to help me find a property. And you say, okay, well, you can probably finance 75%. So you have to put 25% down. And they say, wow, I can buy something for 320 then. No. Let's talk about buying something for 240, putting 60 down and buying something for 240. Because, well, first of all, you're going to have closing costs and stuff like that. But I want them to keep, it's not going to be a huge expensive property, but at least keep $10,000, $15,000 for rainy day for this property. Not rainy day for their life, rainy day just for this property, because you never know what you're going to do. Daryl, you ever gone negative cash flow for months in a property? Yeah, it happens. Happens to everybody. Anybody ever have a flip that takes a year when it should have taken 2 months? Yes, that's me. Anybody get 30 grand less for their flip than they thought they would? Yes, that's me. Anybody glad it was over? Yes, that's me. It happens, right? So high projection numbers with unclear assumptions, deferred maintenance that overwhelms expected cash flow. These are all things that we should try to look for. Some things are going to surprise us. That's all. Some things aren't going to be. You guys know the investor special. When the investor sells it to an investor, what do they always put on their seller's property disclosure? Never occupied it. Don't know. They still have to disclose things that they do know. If something's leaking now or something is, whatever, they have to disclose anything that they do know. But they might not know that this toilet likes to back up a lot because they had a non-complaining tenant or whatever, right? Maybe they were a bad landlord and the tenant just stopped complaining because it didn't work and they just dealt with it. You never know. Buyers undercapitalized or relying on perfect execution. That's what I was just talking about. That was the 80,000. Let's get them down to something where they put in 60,000, right? Because we don't want to put them in a bad situation. And if you're able to explain that to them, it makes a lot more sense. Hopefully it's somebody that has yes, I have money in the market, I have money in this and money in that, and I want to put some in real estate. Well, that's great because they've got these other assets that they can liquefy and cover any expenses. Agent scripts can use. Let's verify the rent assumptions before we rely on them. This is great. This is building value. You're letting them know. You always, guys, and whether you're doing just residential sales or you're doing investment sales, you always want to let the agents know. I'm sorry, the clients know that you're working for them. I think a lot of things that we do, we just do, and we don't tell people, and they don't ever appreciate us because we just did it, right? So let's do that. Let's tell them what we're doing. Let's verify the rent assumptions before we rely on them. This looks promising, but we need insurance, HOA, tax, repair, and financing numbers. And a lot of times, if they're new investors, they're going to say, oh, I didn't think of that for at least some of these, right? Do you want to optimize for monthly cash flow, long-term appreciation, or total return? A lot of times they're going to look at you like you're speaking another language that they do not understand. Do you want to optimize for monthly cash flow, long-term appreciation, or total return? And that's all going to be answered in that questionnaire. I can help with market data and coordination, but your CPA, lender, attorney should confirm the financial, tax, and legal pieces. That is where, guys, when you're selling something, don't give them more problems. Okay, that's why you have a team. If you don't, this should be followed with, if you don't have anyone already on your team, I have people I can recommend for you. Okay, that's, you need to, if you're doing this, you didn't help me when you just said this. If I'm the investor and I don't know much, and I'm a firefighter, or I'm a doctor, or I'm a whatever, this isn't my business, and you say I can help with market data and coordination, great, but your CPA, lender, attorney should confirm the financial, tax, and legal pieces. Whoa. You know, I've got to hire all these people for, you know, to put my $60,000 into something, right? So you should be able to explain basic things, but also have a team of people that they can talk to if they want to. What would make this a no-go for you? So what is your big hot button no? We all have hot button yeses. What is your big hot button no for you? And they may say, you know, I really rather not deal with the tenants myself. Oh, well, we know a property management company, or whatever their no-go is, right? How agents create repeat investor business. Create a simple investor intake form and save target criteria. That is roughly what that investor questionnaire does. Send properties with the numbers that matter, not just the MLS link. Don't just send them properties. Let them know. Once you know what they want, make sure you're sending them the right things. Build a bench of reliable lenders, insurance contacts, property managers, contractors, CPAs, and attorneys. That's what we just talked about. Follow up after closing with rent, repair, refinance, and next purchase conversations. Perfect. That's how you get to all that stuff. You keep adding value is how you keep getting these conversations about, so where are we going to go next? What else would you like to do with your portfolio? And they may say, well, you know, I've got, you know, that they had 10 when they started with you. Now they have, let's say they have 13 now. So is there anything you want to dispose of, or what do we want to do with our portfolio next? Right? Become the agent who helps investors think clearly, not the agent who just says every deal is good. Do not be they can smell it on your breath if you're just telling them everything's great. Oh, this is great. This is great. I just need a commission. Come on. This is great. Okay. Case study discussion questions. There we go. Which property deserves a deeper look? Purchase price, $340 on the property one. Estimated rent, $25.50 a month. Annual NOI, $19.8. Annual debt service, $17.4. Cash invested was $85,000. And annual cash flow was $2,400. Cash on cash return was 2.8%. More expensive. Your agent discussion will be more expensive, lower return. Property B, $295, $2,300 a month. It rents for 19. Or was that 18? I can't read. 18.6 is your annual NOI. 14.7 was your debt service. Cash invested. You invested less cash. You're getting a bigger annual cash flow. So obviously your cash on cash return is higher, 5.3%, lower price, stronger cash flow. Everything about this was better, including the cash invested allowed them to have at least 11,000 in reserve. If you took all 85,000 and put it into the property on the property A, well, property B, at least we know they have 11,000 more cash somewhere, right? So which property has stronger cash on cash return would be B. Which assumptions would you verify first? Which assumptions would you verify first? The estimated rent would be a big one, right? Because that affects everything else. Then I would do your debt service, what my actual payments be on the money I'm borrowing for each one. And that's it. The rest of them work out. So the only things on here that we can verify, obviously we can work on the purchase price. One thing I'd verify is these are the asking prices. How flexible is the seller? How motivated is the seller? And then obviously the rents. The rents are huge. The rents drive everything else. All these other numbers are based on how much the annual rent is, right? So all of them are based. These are all annual numbers based off a monthly number. So we want to verify what that annual rent would be. So if this 2,300 really only rents for 2,000, that kills a lot of these numbers, right? And same for this one. So we're going to verify that first, and then I would verify that first, and then I would verify the purchase price that we can, how motivated is the seller, what do we think we can actually get it for, and then I would verify with the lender what would my actual payments be, what would my client's actual payments be, because that's the least. That's going to vary the least. Okay. What can make property A still attractive to the right investor? We talked about that before. A lot of it's going to be location. They're basing it on location. They're basing it on, sometimes with property A might be a different kind of property that they can get better financing on or put less money down or something like that. That could affect it. What are their tax ramifications of this? Why are they doing this? Are they doing it for long-term appreciation, or are they doing it for just a investment, because they want this money? I'm frustrated because I have $100,000 sitting in the bank that's not doing me any good. I want to put it into something. The stock market is too risky. It's like gambling. True. And real estate seems safer to me. I want to, they're going to say guaranteed. We make sure that they know it's not, but I want more of a guaranteed, it's more of a guaranteed annual return. Okay. And that 5% looks good to them. The 5% is great. That's $5,000 more than I thought I was going to get next year. So let's do it. Right. So these are the things. That's why B could look better. A could look better for appreciation and other things. A might be in a better area, area that's being gentrified, or being this, that, whatever you think values are going up in this area. And that's what will make it attractive. Okay. What risk could make property B less attractive than it appears? We just talked about that. What professionals should be involved before the buyer removes contingencies? Inspector, obviously. The appraisal will be part of the financing. So the lender, and anything else. Let's have the CPA take a look at it and make sure it's doing what we want it to do. So we want to make sure it qualifies for whatever we need. Maybe it's the 1031, maybe it's whatever. We want to make sure it qualifies for all of those things. The first person, just so you know, with 1031s, the first person they should talk to is the intermediary. They have all the rules of when you have to identify properties, when you have to close on them, how many you have to identify, how many you have to close on, etc. What is a like kind property? Make sure 1031 is the like kind exchange. So you can't take property money out of certain things and put them into something completely different. It has to be a similar investment. I can't take my money out of the stock market and put it into real estate. It has to be like kind. Okay. Well, I can, but I have to pay taxes on it when I take it out. Key takeaways for agents. Investor clients care about numbers, assumptions, risk, and repeatable decision-making. ROI is broad. Cash on cash is especially useful for finance rental property. That is most of what we're going to be dealing with. So it's especially useful for that. Cash on cash is not especially useful for cash investment because that's just your return. That's just your rate of return. So cash on cash, the term cash on cash is relevant when we're financing something and I want to know what I'm going to make off of my initial investment. NOI is before financing, cash flow is after financing. Quick screens are helpful, but real analysis needs real expenses and current financing. Your job is to inform, verify, coordinate, and protect the relationship, not give legal, tax, or financial advice, obviously. That's it. So your job, quick screens are what you're going to do to set up your auto email or whatever you're going to do with your client. And when they tell you, they give you a few that they're interested in is when you're going to do more of a deep dive. But more importantly, before all of that, I'm going to take this down and present something else. And I'm going to show you guys our investment questionnaire. Do you guys have any questions in the meantime? I sent you guys the presentation so you can refer to it. I know I speak quickly and we have agents. English is not your first language, and I apologize for that. So hopefully you can review some of the things that I said. And I try to speak slowly, but I get excited about these things like a nerd. But let me see if I can find this. There we go. Wow, this is from, we put it in here in 2017. Yes, question. Daryl Hunt.
You could do this as a part-time gig and charge like $2.99 each. That was a good class.
Well,
I hope everybody was paying attention. You hit on a lot of good stuff.
I really appreciate that.
Actually, back in the day, I have taken a class like this before I started investing. Right. And I paid easily $2.99 to hear everything that you just said. So
I would like to, as a person who has a passion for this, and
yeah,
I would like to go 2.5 hours on this, honestly, because I would like to go into real. You guys you've seen my other presentation. I've done it 5 times on here, probably once a year for 5 years, where I talk about Aunt Sally coming to dinner. Remember that? And I go over her investment that she brings, and I update the numbers once in a while to make it more realistic to today's numbers. But I love that because it gets into the actual meat of it, the actual examples and stuff like that. And Daryl, you have perfect examples from the projects. Anybody who's done these has examples, and they've got horror stories. They've got great stories, right? This property is a angel property, and this one is the devil, right? And so it's I could get really deep into it, but I can't bore you guys for 2.5 hours. Okay, investor questionnaire. This is something I created apparently at least 7 years, or 2017, at least 9 years ago, because that's when it was uploaded to Paperless Pipeline, and I haven't adjusted it since then because it's still the original uploading. All right, investor questionnaire. What is your real estate investment goal? Tell me about your real estate portfolio, properties, rates of return, exit strategies. And again, guys, you're going to get, I like to do this, present it in some way, kind of in person or on a Zoom or something like that, because you get their reaction, you get their face. And a lot of times you're going to know, and it's not a good thing or bad thing. What I want you to see is, do they understand this stuff? How much do I need to go into it? How much do I need to explain this stuff to them? Because like I said, a lot of them, this is their first time investing. They've just got this money and it's driving them crazy that it's not doing anything, and inflation's going up. They're losing 4% a year on their money that's sitting in the bank that they've earned, and they're losing it because inflation's not worth what it was, X amount of years ago. And so, or last year. And so their money, anytime you're not investing your money, you're losing money, because inflation, even when inflation's good, it's 3%, right? So you're losing money if you're not gaining money. What kind of properties would you like to acquire and why? What is your required rate of return on your next investment? They may not have any idea. That's the kind of things that I want to, I don't know, what's a good one? You'll get people to ask you that stuff. What should I expect? Because they don't know. And that's also a little bit of a red flag that this is going to take a little while, right? And they make sure that, they may not be completely serious. They may find out what these numbers look like and be like, oh, I'd rather just put it in a hedge fund, whatever. How long do you plan to keep it in your portfolio? What would you like to acquire the property? And I'm going to go back to that. Sorry. I'm thinking back to the hedge fund and all that stuff. Guys, don't be afraid to ask these questions, because they might say, I'm just going to go take it elsewhere, because you might lose the client. Losing the client right now in our first conversation on this questionnaire is a lot better than losing it after I've wasted a bunch of time and shown them a bunch of properties. Lose the client now if you're going to lose them. And guys, investors, everybody who's ever thought about investing or ever bought anything calls themselves an investor. So you'll get somebody approach you and say, oh, I'm an investor. Would you like to, will you help me find some properties? Obviously, I'm not talking about the 10 texts you get every day on your phone about this. Hey, you don't happen to be a realtor by chance, do you? I'm looking to buy. Yeah, you got my name off the realtor thing because I don't advertise. You got me from Aura, you got me from Stellar, you got me from somewhere, because I'm not advertising. So don't send me a text that says, I'm not out there advertising with you guys. So you guys get those and you might be like, yeah, I wonder where you got my number. I get them and I'm like, you bum, leave me alone. I report spam. So, because, hey, do you happen to be, are you sending a text to everyone in the world? Do you happen to be a realtor? I doubt that. So, although in Florida, it's probably a good strategy. What kind of properties you like to acquire and why? What is your required rate of return on your next investment? How long do you plan to keep it in your portfolio? We'll get to exit strategy here in a little bit. When would you like to acquire the property? That's kind of important, right? Are you looking to invest strictly cash, or are you going to use leverage? If leveraging, for how much are you pre-approved and with whom? Do you plan to manage the property yourself, or is it a passive investment? Explain to them what goes into managing these properties. And then, look, nothing's free. If they say, oh, that's not something I want to get involved in, then, I don't want to collect from my tenants. I'm afraid, and this is a very legit thing to be afraid of. I'm afraid if I go to my tenant's property in December and it's a single mom or single dad with 4 screaming kids, and they tell me they can't have Christmas this year, it's hard to collect from that person, isn't it? And they see your face at the door and they know you're the decision maker. I've told you guys this story before, but I used to have these 2 friends. Well, still have them, but they used to manage each other's properties. So one of them like 5 properties, one had like 3 properties. And they said, you collect from mine and I'll collect from yours. And that way they can go to the door and say, oh, sorry, he's a jerk. He's got to have his money, because they didn't think that they had the heart to collect from these people if they had to do it themselves. And when you're the decision maker, this is why when you go to the car dealership, they don't let you talk to the guy behind the thing that they got to go talk to, right? The decision maker who can say, yeah, we can sell it for that much. They keep a buffer, and that way they can, sorry guys, end of month's coming up and he's got to meet his numbers or he'll get fired, whatever, right? But it's hard to collect sometimes. And do you want a property management company? Do you, and if you told them some horror stories, Gerald, you manage your properties, don't you?
I used to. I sold everything actually, 3 years ago or so.
Okay.
Yeah.
So but you did. You got some horror stories, I'm sure.
We managed things for 30 some plus years, South Florida and Central Florida.
Yeah. And I bet you have some horror stories. And I bet you saved a lot of money doing it, but you've got horror stories. And that's the trade-off that people need to figure out. Because a typical property management company is 8 to 10%, plus they'll find tenants for you and charge you a month's rent, et cetera. So you got to know does that bite into your numbers? Big time, right? We were already thin at 5.5%, and now I'm going to pay a property management company. Right? We're at some point we're just hoping on appreciation at some point, right? So, are you purchasing in your own name or using an organization, LLC, trust, et cetera? They'll say, well, a lot of them will say, well, what's the difference? That's where you talk to your CPA or your lawyer, right? Have you spoken with tax or legal professional regarding the benefits, drawbacks of using an organization? There we go. So this is your investor questionnaire. You can add your own questions to it. You can do whatever you want. It is a PDF in here. I can give you the Word file if you need it, if you want to do professional looking, but I think it almost looks better to handwrite some questions in the margins for them. Makes it look like you made it for them. All right. So I love that questionnaire, obviously because I wrote it, but also because I think it covers a lot of stuff. So I think it's a great value for you guys. Any questions on that? Juliana.
Yes, I have a question. I have someone that is looking to purchase their home. The CPA told him, yes, purchase it under an LLC. But now he's asking me, what should I do with the second one, the one that he had from before, which was his primary home at some point, and he purchased another house to live in, and now he's renting the other one. So he's asking me if he should put the other one, the old one, under an LLC. But wouldn't that trigger like a balloon payment or something like that if he does a quick claim deed to an LLC?
Juliana, it worked so great for him last time asking his CPA. He needs to continue.
Go back to him.
This is a great CPA question. I don't know his tax issues at all. He needs to ask his CPA. He really does. You don't need to answer that question. The question of should I put this in LLC should not be answered by you ever.
No, so he's going to purchase under an LLC, but the old house.
Right. I'm saying the old house, should he transfer it into that same LLC or a new LLC, or should he leave it in his name? I don't know. So I know that there are going to be expenses involved with moving it to an LLC. You quick claim it to that LLC. It may trigger loan payment probably if he owes money on it. that might, I think that will, if you change the deed, they're going to call the loan.
Right.
Or they'll penalize you a certain percentage of the loan. That happened to me before. We changed names on the deed, added a name to the deed, and they charged me 0.5 point or something on what I owed on the property. The bank did, or maybe it's the government. I don't know. I think it's the stamps on the note. You owe the government stamps on the note for that. So that's a CPA question. I cannot tell you what it is, but that's a CPA question.
Okay.
And it might trigger repayment of the loan. It might trigger like mine did. It triggered notes on the mortgage. I had to pay the state. I remember it was like $1,500, and I regretted it. They sent me a bill. I did not ask ahead of time. I did not ask a CPA ahead of time, and it cost me, I think it was $1,440 it cost me. I don't know why I remember that.
Okay.
All right. Yeah, he could lose homestead, etc. CPA, that's a great CPA question. There's lots of things to consider. And I think I would lean toward just leaving it in his name. It's going to be a single asset LLC anyway. I don't know what, but I don't know what the business the guy's in. He could be sued for millions of dollars if he's in a certain business or something. They can come after your single asset LLCs too. So it's, LLCs only protected if you have somebody else in them, really.
Yeah.
I mean, it helps. It helps with what happens at that property, but you can still be personally liable for stuff beyond that if it's a single member LLC.
Right. Okay.
A lot of people, I will tell you this, a lot of investors do single asset LLCs, where they do, every LLC they have is named 123 Oak Street, whatever, named after the property, and they own that LLC, and it'll be just me or just me and my partner or whatever on it. There's a lot of single asset LLCs, and there's single member LLCs, and those are two different things. Obviously, the members are the people, the asset is the property, and that's an all CPA thing. And yours is different from mine, different from Daryl's, different from Tammy's, different from Pauline's. Everybody has a different needs and different goals and everything else, different situations. Okay.
Mm-hmm. Thank you.
All right, Daryl Hunt.
It's a CPA question and a lender question, because each lender has their own rules as well. So he might have a totally different loan than any one of us. So we couldn't really, nobody can answer it.
CPA needs to look at, CPA can look at his note, and they'll probably ask to see his note, because he's going to say, do I, is it going to call my note due? And the CPA said, I don't know. Let me see your note. They can't make that decision until they see the note. Then they can. All right. Great question, though. I am loading the chat, and it's taking a while to load. I don't know why. There it goes. Was that before the meeting, Daryl? That might have been me making my coffee. I feel like I'm in my real estate class. Different places, condos, HOAs have different financials. An issue with Facebook.
Somebody was just loud making breakfast, I think.
I was making coffee, and I thought, oh, I didn't turn my I had my camera off, but I didn't have my sound on, which is a bad idea. Okay, any other questions? Oh, Patricia put together this rental calculator for clients English, Portuguese, and Spanish. Gives a pretty good generic idea. Oh, fantastic. Well, that's cool. I'll take a look at that. Oh, cool. You guys click on that. It's pretty cool. Thank you, Patricia. You put that together? That's impressive. Fantastic. All right. Well, if you guys don't have any other questions, I don't have anything for you. If you, we're doing great. April's another great month. You guys are doing awesome. Gigi. Oh, okay. Patricia used AI. That's fantastic. Gigi, you had a question or accidental? All right. All right, guys. Well, if there's no other questions, April, you guys are doing great. April's been fantastic. March was the best in a long time. April may be or not, depending on what you guys got closing in the next day or two. Sorry, an accident. Okay. Feel free to use and share. Patricia saying, that's great, Patricia. Thank you very much. But Patricia put that together with AI. Patricia, are you a web designer or anything? I I know she's not. So AI did most of it. Patricia was the brains behind it. But thank you, Patricia, very much. That's really, really, really cool. Let me see if I can do something with that, actually. Here, I'm going to share this with you guys in case you're lazy bums. I'm going to share this with you. There you go. Blow it up a little bit. All right. Look at that. That's fantastic. Portuguese. Espanol. Fantastic. And you guys can use that. That's great. Thank you very much. All right. Well, thank you all very much for coming. I will see you guys next week. We'll have something good for you. And oh, you used to do. Okay, still know something. That's fantastic. Good job. All right. Thank you all for coming. I'll see you next week. Share it again, please. Yeah, if you can't scroll up, it's, well, I can do it because it's right here. Or she can do it. All right, guys. Have a great week. I'll see you next week. Keep up the great work. Take care, everybody.